Hello everyone, and welcome to today's episode of A4 Finance Talk. My name is Kat Alvarado, financial analyst here at A4 Finance Group. Today I'll be giving a brief presentation on what a sensitivity analysis is, why A4 Financing Group uses it, qualitative and quantitative steps used, and how risk is incorporated into capital budgeting. First of all, what is a sensitivity analysis? It's a very useful tool that helps businesses forecast and predict investment values. It's best known as the what-if scenario or opportunity, where we input hypothetical numbers into established formulas to calculate and figure out future calculations. It helps our clients determine whether or not an investment is worth it. Based on things like current financial information of our competitors, cash flow, anything on a balance sheet, we can make solid assumptions of things that tell our investors how results would differ if a specific variable was changed, as reported by Maverick in 2022. Our financial analysis text states chapter after chapter as well that decision making and sensitivity analysis is heavily linked. So let's go on to what some of the benefits are of a sensitivity analysis. Well, there are quite a few, but the main drive on having a sensitivity analysis is to provide insight into the future of investments. It provides crucial data that can yield the most impact on a given financial scenario. It takes a reliable, deep look at variables and decreases the amount of ambiguity for our investors, as mentioned by Kenton in 2022. It helps decision making, and ultimately it can earn and retain the business of our investors right here at A4 Financial Group. What are some examples? Well, we could adjust the ratios like the profitability index, the PI, of a financial statement. Another example of a sensitivity analysis could be adjusting earnings before interest and taxes, the EBIT, between a specific time frame. Also, calculating the net present value, the NPV, using different variables within the formula. So, if we determine that the NPV is greater than 0, we know that the investment is likely a good one and it should yield a profit. However, if we change one single variable that causes the NPV to be less than 0, well, we know that investment is not a good one and we would not likely see a profit based on that scenario. Necessary quantitative steps in a sensitivity analysis. Well, based on what the term quantitative means, we rely on dollars and time, as reported by Belinda Fermo of passion@pm.com. There are a multitude of steps that an analyst can take to complete a sensitivity analysis, as stated by Carl Thompson in 2017. The A4 Financial Group protocol follows 8. From identifying the problem, planning and documenting findings, to deciding which investment option is best. But for the sake of time today, please take a snapshot of the slide for all the steps that we do take, including the ones I just mentioned. Next, when discussing qualitative research, the A4 Financial Group uses data that's not so numeric, but is very valuable. It is responses to surveys, measurements that are observed in the field, mirroring the steps mentioned in a Scribber.com article by Bendari in 2022. These qualitative steps are prepping data, organizing it so that it coincides with all quantitative data, reviewing data to examine possible patterns, categorizing data by theme or relevance to your research, identifying and recording any repetitive areas that can be linked to statistics and probabilities for the sensitivity analysis. Now, how can a project's risk be incorporated into capital budgeting analysis? Well, any investment has risks. We all know that. A capital budget is a financial plan that aligns itself with those risks and long-term investments. Because risk is always a factor, we integrate capital budgeting so that investors are able to reduce the amount of losses in a given plan. Now, part of that plan is performing a SWOT analysis: strength, weaknesses, opportunities, and threats. A project's risk would be incorporated into a capital budgeting analysis by means of a risk premium, payback period, and guess what? Conducting a sensitivity analysis, as mentioned by Adams, which brings us full circle on why sensitivity analysis is such an important tool in financial investing and forecasting overall. That's all for today's A4 Finance Talk. We'll take a closer look at all of these topics during our one-on-one onboarding later this week. For now, thank you for joining me today. Be well, be blessed, be prosperous.